Hey, what is going on, guys? My name is Nick, and in this video we're going to be discussing the possibility of another stock market crash happening in the near future here based on all of the facts that we know to date. Along with that, I'll be giving you guys my unprofessional opinion at the end of the video, so make sure to stay tuned for that. So ever since this whole global issue struck the media back in February, the stock market has been seeing some insane volatility, to say the least. We've experienced the fastest 30% drop from all-time highs in stock market history, which only took a mere 22 trading days following the market highs on February 19th. And throughout that whole period, we've seen stocks hit record daily drops, activating market circuit breakers, which essentially give investors a period of 15 minutes to calm down before spamming that sell button again in their brokerage accounts. But then, to basically everyone's surprise, stocks climbed nearly 30% from the market lows to where they're at today. And just taking a look at a one-year chart of the S&P 500, we find that stocks have essentially remained flat. Now, if you're an investor in this market, well, first of all, congratulations for staying invested through all of this mess. But secondly, this begs the question, will stocks crash once again? And in order to answer that question, we have to be as impartial as possible by looking at both sides of the equation. So in today's video, I'll be looking at the reasons why stocks might crash again, and then the reasons why they might not crash again, and then give you guys my overall opinion. So if you do enjoy this video, make sure to smash that like button. It really does help support my channel. And if you haven't already, definitely consider subscribing down below for more weekly investing videos just like this. So with that said, let's start by getting into the reasons why the stock market might crash again. Now guys, some recent economic news came out on May 13th after the Fed made a public statement that caused a lot of fear amongst investors. And essentially what it was is that the Fed warned of a deep global recession on the horizon, which is reason number one why stocks could crash again. Now, to quote Jerome Powell verbatim, he said, "The scope and speed of this downturn are without modern precedent, significantly worse than any recession since World War II. We are seeing a significant decline in economic activity and in employment, and already the job gains of the last decade have been erased." So guys, just from this, basically what he's saying is that the magnitude of this recession that we could be seeing has already wiped out all of the progress we've made over the past 10 years in terms of job gains. But also that things could be getting much worse because we haven't seen anything like this since the Second World War. Yet it's really fishy when we see the S&P 500 has risen 30% from the lows in March, and it's essentially flat over the year. But despite what stock prices are doing at the moment, we can basically assume from what the Fed had to say that a severe recession is on the horizon. And based on what we've seen in history, this can take a significant toll on stock prices over a period of 1 to 3 years. But aside from the comments of the Fed and warning about this recession on the horizon, the second reason why we could see another stock market crash in the near future here is because of unemployment trends. Now, getting right into the numbers, guys, what we figured out from April of 2020 is that the unemployment rate was sitting at 14.7% across the United States. And another way to frame it is that payrolls have been completely wiped out for over 20 million Americans. So as a result, an entire decade of job gains has been completely abolished in a matter of 1 month. Now, just hearing these crazy numbers might not actually give you a full understanding of what's at stake right now, but if we compare this to the historical jobless claims chart, we can see just how unprecedented this situation really is. And guys, the only other time in history when we've seen these crazy unemployment numbers on the same scale as this was in the Great Recession, when the numbers were at 24.9%. And to be honest, the amount of unemployment is probably going to continue rising over the near-term future, so we really don't know what's in store. Now, the third reason that could be influencing another stock market crash here in the near future is because of company bankruptcies. So to date, there have actually been tons of larger companies, especially in the retail sector, filing for bankruptcy protection, whether it be Chapter 7 or Chapter 11 bankruptcy. And while many of the larger companies are getting federal aid from the US government in terms of bailout money like the US airlines, many other companies are not, and this is resulting in bankruptcies. For example, some of the bigger names of companies that are filing for bankruptcy that you may know about are Pier 1 Imports, JCPenney, J.Crew, Gold's Gym, Virgin Australia, along with so many other big names. This means that the banks that worked with these companies are going to be losing billions in terms of loans, along with all of the jobless claims that are going to come out of these bankruptcies. And at a time like this, when the economy is not even fully reopened yet, we can only expect more to come. Finally, guys, the last and most important reason that could be influencing another stock market crash here in the near future is because of a second wave. Now, I'm sure many of you have heard about this because of the media being all over it, of course, but there is in fact a strong possibility that the Rona situation could get worse and could go for a second wave once we open up the economy. In fact, the director of the CDC recently warned a second wave of the Rona is expected to hit the United States next winter and could strike much harder than the first because it would likely arrive at the start of the flu season. So basically what this means is that all of the hospitals and health institutions could be overwhelmed once again, not just from the Roni, but from the flu as well. And if this did happen, this could result in the economy shutting down once again, which would absolutely be detrimental to the economy and would almost certainly cause another stock market crash given what's already happened. So to summarize, basically what we know right now is that the impact to the overall US economy has been detrimental. And it's really hard to imagine stocks hitting new all-time highs in the near future given all of the points I just talked about. But now let's flip to the other side of the coin and start talking about why the stock market might not crash again, which is actually very probable. Alrighty guys, first of all, we gotta talk stimulus. As you would all know, over the past few months, Congress and the Fed have been pumping money as fast as possible into the economy to stimulate it once again after all of these terrible events have transpired. And all of this financial aid that has been provided to the people of the United States can be separated into two different buckets, that provided by Congress and that provided by the Fed. Now, by quoting Jerome Powell on May 13th when he made his public appearance, what we can find is that Congress has provided roughly $2.9 trillion in fiscal support for households, businesses, healthcare providers, and state and local governments, about 14% of gross domestic product. While the economic shock appears to be the largest on record, the fiscal response has also been the fastest and largest response for any post-war downturn. So Congress acted very quickly compared to historical standards to be able to provide that $2.9 trillion that everyone needed. And that is likely the contributing factor to why the stock market has recovered so quickly from the lows in March. And not only that $2.9 trillion that the US has already received in stimulus, they are going to be receiving the HEROES Act, which will be a $3 trillion stimulus package. In fact, the bill just passed the House on a vote of 208 to 199, which means that more stimulus should be coming very soon to help American families. So by Congress taking this proactive approach and helping Americans additionally, this could also prevent the stock market from crashing again. And not only did we see all of this action from Congress, but the Fed has been stimulating the economy in different ways. Jerome Powell also stated, "At the Fed, we have also acted with unprecedented speed and force. After rapidly cutting the federal funds rate close to zero, we took a wide array of additional measures which can be grouped into 4 areas. And to summarize those 4 areas in which the Fed has been able to help out the economy, they are, firstly, purchasing of treasuries and mortgage-backed securities, secondly, additional liquidity and funding measures, thirdly, additional credit facilities to households, businesses, and local governments, and finally, the temporary regulatory adjustments to help banks manage their balance sheets in a horrible time like this." So with all of this ongoing support from the government and the Fed, it's really propped up stock market prices, and it should help in the near term at least. Now, the second reason why we might not see another stock market crash is for this following reason that I just touched on, and that is interest rates. As we all know, a few months ago, the Fed lowered the interest rates to essentially zero, which is the lowest level in US history. And it's most likely going to stay like this for the foreseeable future until things start getting a lot better. But not only are interest rates at zero right now, but futures trading is actually suggesting that interest rates could be negative into 2021. Now, negative interest rates have been completely unforeseen in US history and haven't even really been a talking point until recently. And what this would mean is a complete shift in the economic system and the way it operates, which would hopefully stimulate the economy to the point where we don't experience deflation. But although Trump is pushing for these negative interest rates as hard as possible to help his presidency move forward without getting too political, the Fed is not even considering this at the moment, so it only remains a possibility. Negative interest rates would only likely be a last case scenario to avoid deflation, so right now it's not on the horizon. But if this were to happen, however, we would see a huge surge in asset prices, including stocks and real estate, because people would be less incentivized to hold their money in the bank. And at the same time, money would become so cheap to obtain a loan, it would be ridiculous to not get a loan and put that money into real estate or stocks. But guys, of course, this is just speculation at this point, and it's not certain that we're going to see negative interest rates. And even just the fact that interest rates are the lowest that they've been in history, sitting at zero right now, there is a good chance that this will help stimulate the economy. So corporations will pay less interest, homes will be more affordable for people, and overall it's going to benefit the economy. Thirdly, guys, we need to talk about the US economy reopening because it is happening at the moment. And guys, this is one of the strongest points to understand when evaluating if stocks will continue to rise or if they're going to fall. So as of now, the US government has already started loosening many of the shutdown policies across the country, and many states are starting to reopen. As of May 16th, we can see that the majority of the US states have actually begun to reopen, or simply initiating a regional reopening process, which is good news for the economy at this point. But we do have to ask ourselves, is this move of reopening the economy too soon? Is it sustainable? And that's something we're likely only going to figure out with due time. But as for now, we can assume that this will stimulate the economy and that things should be getting better generally. As all of these companies that have shut down start to gain a grasp on profitability again, it should allow them to hire more workers, which will stimulate the economy. But in my opinion, if we're being realistic, this will likely be a slower transition and could take 6 to 18 months to execute. And finally, guys, the last reason why stocks may not crash again is because of what we see over history in World War II. Interestingly enough, if we look at the performance of the Dow Jones Industrial Average from 1939 to 1945, i.e. the beginning of the war to the end of the Second World War, we actually find that it rose 50% over this period. However, what I actually found over this period is that the economy dipped into a serious recession and actually dropped GDP by 11%. So although stocks were up and down between 1939 and 1945, and it troughed in 1942 at the lows, the Dow was able to climb to much higher levels by the end of the war, which was very surprising. Now, being the devil's advocate, this could be due to the economy having recently come out of the Great Depression. But what it shows is that even though we're probably entering a pretty crazy recession at the moment, it doesn't mean that stock prices are going to be much lower coming out of it. The stock market performance is highly dependent on many different factors like the Congress support, the Fed support, so we can't tie it just to a recession. And to date, because we've seen so much proactive support from the Fed and Congress, this could leave the market in a much better position than it has been after past horrible events. Alrighty guys, so giving you my opinion, what do I think is going to be happening? Well, first of all, I just want to make it clear that it's nearly impossible to predict the short-term moves in the stock market, and by short-term, I mean over the next few months or the next year. And it's always so important to remain invested regardless of what the economic data suggests, because there is a strong difference between the economy and the stock market, and they don't always align. But based on everything that I've showed you guys here today, I would take a guess and say that we're not going to be seeing the March lows once again unless something else happens and we get some more worse news. And personally, I believe this to be true because of all of the Fed support and the Congress support adding up to over $6 trillion at this point. But I do also think that we could see another correction of about 10 to 15% if there's some bad news that comes out, or if the economy is not opening back up to plan, or if the Fed doesn't continue to print money and support the economy as needed. But overall, there are just too many factors to explicitly say where the stock market's going to be over the next few months. However, I believe it's important to stay invested right now, remain in the market despite all of this negative news in the media and with the jobless claims reports and everything else. So I will personally continue to buy the dip as the opportunities present themselves and dollar cost average into the market. And hopefully we as investors will emerge from this better than before. So anyways, if you did make it until the end and you enjoyed this video, make sure to drop a like on this to support my channel. And let me know your thoughts down below if you do think that the market is going to crash again and by how much. It's honestly just a big gamble, so I'd be really interested to hear what everyone thinks. But anyways, if you haven't already, definitely consider subscribing down below for more weekly investing content just like this, and I will see you guys in the next one.